We previously looked at over 180,000 backtests comparing different strategies and types of spreads for statistical arbitrage to see, could we objectively identify features that could help me figure out which trades would be more profitable than others, which ones should I avoid, what features mattered, what sort of thresholds mattered. And I had a big warning there to say, hey, backtesting is fraught with issues. What I didn't really go into in much detail is that I had started forward testing these strategies, which in my opinion is 100 times more beneficial and useful. And we now have 5,525 trades, obviously nowhere near the 180,000 because the data didn't exist. We had to wait for the trades to actually happen in real time. And that's why this is so valuable. With forward testing, what happens is you run your back test, you get all your information, and you decide to place a trade. Now, you can either use live capital to place that trade, in which case you have to just care quite a lot about capital preservation, because by gathering data, you're also accepting trades you normally wouldn't place to see how they would have performed, and you can lose your whole bankroll. So with this, I didn't use real capital because I wanted as much data as possible without having to care about capital preservation. But the point is, we would go and simulate a trade. We'd get the live price from, say, Binance. We'd assume some slippage. We would assume commission fees, and we'd assume we get that price. And then we'd wait for the trade to play out. We'd see, okay, has it mean reverted? And then we'd close the trade. And so that's what forward testing is. You essentially are live trading, or you're pretending as though you were live trading. You're not just looking at historical data. You're only using historical data like you would in live trading. And so it gets rid of a lot of look-ahead bias, and that's why we don't have as many trades. But we do have enough data to run at least some machine learning algorithms. Not as much data as I would have liked, but over 5,000 rows of data is enough to start getting some kind of idea of what's going on. And I wanted to share that with you in this video. So when trading just the spread, so the spread itself, no rolling Z-score, and if these terms don't mean anything to you, please go and watch one of the recent videos on the channel, Introduction to Pairs Trading, or what is statistical arbitrage, or statistical arbitrage for beginners. I'll put some links in the description so that you can go to those if you need them. But just trading the raw spread itself, no rolling Z-score, these are the results that we can see. Now, I need to caveat this. You can see, for example, on dynamic spread, it says we got nearly 50x returns. You would not have got that in reality. And for those of you who are trading these live will be looking at this going, no bloody way. And that's right, because execution is half the battle. And so the slippage in reality, if the crypto hasn't got much liquidity, you would have got much worse pricing than this is assuming here. So please take the numbers with a grain of salt and just look at these charts based on consistency. Does this look like it made money consistently over time? What does the trend look like? Now, all of them made money. And by the way, I had no special filters that I put in here. I didn't say, oh, okay, we have to have a hedge ratio of X or an ECM of Y or all this complicated stuff. I just said, okay, is the spread at -2? Okay, cool. Go long on the spread. And then when it mean reverts to 0, close it. Or if it's at +2, go short on the spread. And when it mean reverts, close it. That's it. That was it. So I accepted every kind of risk out there that there is so that I could gather the data. And funnily enough, just doing that alone was actually profitable. So that was really, really interesting to me. And it was profitable in all three cases. Again, you would not have got 50x returns, but it did show that, hey, this was profitable if you got good pricing, which you wouldn't have in some cases. So the dynamic spread really, in my opinion, in terms of consistency, performed the best. It had a very slow start off for the first, say, 33 trades, and then now up to about trade 400 or whatever, it's just been really a straight line up. The next one, which is the Ornstein-Uhlenbeck spread, really didn't perform very well to start with at all. And then it all of a sudden had this huge ramp up. So what's interesting to me about this, and by the way, we're going to come on to the features in a minute. We're going to look at all the machine learning and the objective data in a minute. This is just to give you an idea of how these things performed. The OU spread, it really didn't perform well to begin with, but look at the losses. They're tiny. I mean, I could show you literally every single one of those trades. And the losses really, they were really tiny compared to the gains. And then finally, the static spread actually ended up showing the highest returns. Again, you can't believe that returns number. But it wasn't as consistent as the dynamic spread. It's actually a lot more like the OU spread. So when we did the back test on the dynamic spread, this is what we showed. So in the last video, we showed these here. We thought, okay, half-life is really important. Then hedge ratio, then how many times it crosses the standard deviation. All of those were really important for the back testing. But with the forward testing, of course, we have far less data. So this is subject to a lot of change as more data rolls in. We get a very, very different vibe. So we have the same sort of precision. If I go back to the back test, we had 64% precision, 0.64 there next to that number 1, when trying to precisely predict will the strategy be profitable or not. And in reality, it's more like 60 or 0.59. But the features that were the most useful were, first of all, U2 given U1. This is a Copula feature. This means that given the blue asset, what are the chances of the red asset being less than or equal to where it is? And the higher that number, it seemed the better for predicting profitability. The next one was the hedge ratio. So this also had a fairly decent score, I would say 10.8, and then it starts really diminishing. But the hedge ratio was also quite important in determining profitability. Now, also interestingly, 50% of the time, the dynamic spread here, so using the dynamic spread, was profitable. And when I go back to the backtest, it was profitable 71% of the time. So you can see the backtest is over-egging it by at least 20%. In reality, it's more like 50-50, which is great. I'll take those odds every day, because when we're gaining, like we saw, we should be gaining more than when we're losing. Now, that's caveating execution. If the price you're really getting on execution is terrible, that's going to change. But here, again, just to understand what features can lend, in favor of your trades, this could be very insightful for you. Interestingly enough, even the rolling Z-score featured here as something that can be quite important. On the SHAP analysis, the beta, the current beta, was also quite interesting. The current beta is on Crypto Wizards. In fact, I'll show you now. If you go down here and click on betas, you can see it's this number here. So a beta, when you're comparing two assets together, is just saying for every point, for example, here, Ethereum moves, how much does RDNT move? Now let's move on to the OU. You can see only 18.6% of the time this was profitable. You saw that by the chart I showed you earlier. There were tons of losses, but the losses were tiny compared to the gains. But when I ran the machine learning on this, I had to balance it out. I had to remove a lot of the losses in the machine learning to help it with the precision, because otherwise it was just going to try to overfit and predict that everything is always going to be zero. So, fiddling around with the machine learning side of the OU I found a bit more tricky. The most useful feature is this ECM gamma latest. So what is the ECM gamma latest? Let me show you that. If I go and switch this over here down to ECM, this is the error correction model. This is taking everything it learns based on the co-integration of two pairs. And actually, this pair I'm looking at here isn't co-integrated. But if I click on this gamma over here, I'll get rid of these two. You'll see this purple line. Now, let me actually find a pair here that is co-integrated. Let me just check this one over here. Okay, this should work fine. I'm going to look at this one, and I'm going to select down here ECMY, and I'm going to select the gamma over there. Perfect. So what this is saying is the spread is reacting to itself by 1%. So it's looking at its past value over here and reacting to itself. And that's what this gamma is telling me. It's actually telling me this in, again, time-bound format over here. If I look at the gamma here on this side, that's static. It actually gives me the numbers, for example, 0.61. And here it's 0.01 in real time. Now you can see here, the higher that number, the better. So if you look at the SHAP analysis here, the higher the number there, the better. Let's move on to the next one, the static spread. So with the static spread, the precision is actually really good. We have 66% precision over here. 23% of the time, this strategy here was coming out as being profitable. Now, when we looked at the back test, it was 85.4% of the time. And I remember mentioning in that video, especially the static spread is fraught with look-ahead bias, because when you're estimating it with your backtesting data, you're getting a hedge ratio based on the data that you wouldn't have known back in time. So when we do this for real, we're seeing a much lower rate of profitability without putting any filters on, right? So this is just saying, okay, if this thing is -2, buy. If it mean reverts, close out your trade. But it was very, very interesting. Again, the ECM gamma came out on top. And interestingly enough, the Copula U2 given U1 again came out on top. And then how many times it crossed the 0 line. Half-life did feature here. So did the other Copula item, the conditional probability U1 given U2. The beta, I'm talking to everything above 10, by the way. If it goes below 10, I'm not really going into this in any detail. Also, the backtest featured in here. So this returns total was based on the backtest we did when we decided to place the trade, which is information we did know because this is forward testing. So that was really interesting. And when you balance all of this out, you get to 66% precision here on the machine learning side. So you can predict whether or not the static spread will be profitable using machine learning with a really high degree of precision. Anything over 54%, by the way, to me is really good. So if you're getting over 54%, you've got an edge. Like there's an edge here, as long as you're not overfitting on your machine learning side. So now if we look at the rolling Z-score strategy, so not just trading the spread itself, but trading the rolling Z-score, then this again became really interesting. We started seeing, very different results. So the dynamic spread, doing a rolling Z-score doesn't really make sense in the sense that the dynamic spread is really already dynamic. It's already rolling itself. So with that, it's probably worth just trading the raw spread from what I can see here. If you're trading the rolling Z-score on the dynamic, maybe you're seeing a lot of choppiness. You're seeing sometimes you're making tons of money and other times you're not. The OU all of a sudden shows very different behavior to what we had seen when just trading it raw. Now with the OU as well, typically you would only trade that if you had an optimal entry and exit, which I did not build into the forward testing here. So with this, all of this OU stuff, I'm just, taking off all filters and saying, let's just keep it as simple as possible to get as much data as possible. So with the OU, this looks way, way, way better to begin with than it did before, although it doesn't have that sharp spike up that we saw when just trading the raw spread. The static absolutely skyrockets and then it sort of levels out. So it's almost nice to combine the static rolling Z-score strategy potentially with one of the other raw strategies. I'm just giving you ideas here. Again, this was only on 2,787 trades, which in my opinion is still not enough to just place concrete trades on, but at least it gives you an idea of what you want to test. So looking at the dynamic rolling Z-score strategy, 45% of the time this was profitable. And when looking at the back test, the half-life was the most important thing, and 43% of the time or 44% of the time it was profitable. So it's really kind of in line with the back test. And what's encouraging to see here is with the dynamic, like I said in the back test video, it's unlikely there's as much look-ahead bias on the dynamic spread as there is on the static spread. And I went into the reasons for why that is. And we can actually see that here, 43% of the time. Over here, this is profitable on the back test, and then on the forward test, so removing all that look ahead bias, we have 45.5% of the time. So that's really, really close. Funnily enough, the hedge ratio and the long-term beta came out as being the most useful. You can ignore the closed over here. I don't know why I included that feature in there. That just says, was the trade closed, yes or no? And that should have all just been the same number. So it's probably something I've messed up over there. The maximum drawdown as well. So the maximum drawdown is the maximum drawdown based on the back test we did before we tried to place the trade. That was also an important feature. And so the higher that maximum drawdown was, ironically, the better this thing performed in live testing, which is completely counterintuitive. Anyway, when we looked at the back test for the OU spread with the rolling Z-score strategy, it was about 49% of the time it was profitable. And now it's actually still 49% of the time profitable in reality, which means our back test was rather reliable in terms of like a win rate as compared to the actual forward test. So that's very encouraging. But what determined profitability, going back to the back test again, was the standard deviation crossing. So how many times the spread crossed 2 standard deviations, the half-life in the Z-score window. When I go to the forward test, it's nothing like that. You're probably wondering, what is this entry thresh delta? What does that represent? All that is how far was the Z-score from where the entry point was? So for example, if the entry point on the rolling Z-score, which we're looking at here, was 1.5, which it is, so negative 1.5 or plus 1.5, how far away was the Z-score from that point? So the machine learning model is saying, this was actually really useful information to make predictions out of. And look here at the precision, by the way, of our model. It's 67%, so 0.67. And I didn't have to do any rebalancing when doing the machine learning here because, again, it was like basically a 50-50. So half of the time, this was actually profitable. So the rolling Z-score strategies here start to look like really, really appealing. And the next thing is the kind of Copula. So the Copula ID, it found really useful as well. So if I look down for Copula ID on the SHAP analysis, it doesn't think it's nearly as important as the XGBOOST model did. But it is suggesting that the lower the ID of the copula, and I'll refresh your memory on what that actually means, the better it was over here. Now, looking at the back test for the static spread on the rolling Z-score, we predicted 50-50, so 49% of the time this being profitable, and half-life again being really, really important there. But when we actually go to the forward testing, again, it's 50% of the time it's profitable, which is really interesting to me because I wasn't expecting that. Even though I've seen this data, static spread with rolling Z-score, it's so old school and everyone's like, okay, it's old school. Should I be doing something more advanced? This is saying, no, this is actually really, really good. This is very, very good. Although what I would say here in terms of the machine learning, it's got 56% precision. So the machine learning model is struggling to really gain much of an edge here on whether a strategy will be profitable or not on the static spread here. If I go back to the OU spread, we can see that it's got really high precision, 67. And if I go over to the dynamic, it's 61. So going back to our static spread here, it's only 56. Now remember our copulas. So the lower the ID, the more the copula is on the left. So the Clayton copula would be 1, the Gaussian 2, the Student T3, and the Gumbel 4. So these are our copulas. When it came to doing the forward testing, this is what our copula results look like. So we got 723 forward tests with copulas, and this ended up being profitable too. Not as consistent as some of the other charts, but again, extremely, extremely promising over here. So it turns out copulas and statistical arbitrage, there's a reason why hedge funds and institutions use these things. It's because objectively, they actually work. Now, I need to caution you here as well. I know for some of you watching this, you're going to be looking at this going, oh, I'm doing my trades wrong. Like I should be doing this, or oh, now I'm completely lost. Maybe I'm getting this completely wrong, or oh, this is too confusing. I am a data nerd. I love gathering and analyzing data. And in fact, I could do this analysis in 6 months' time and show you very different results. Don't change what you're doing. Trust what you're doing. Use this only if it's useful to you. Only if you can see something ties in with what you have experienced yourself in the markets. And that's really, really important because doing any kind of forward testing and back testing, I've been doing live trading in something else at the moment, a lot of live trading with real capital and with pretend capital and with back tests. So doing all three. And each phase is completely different from the other. And what really matters is the live capital trading. So maybe what's a good idea for you, now that you have a gauge here of some filters you can start with, some things you might want to try if you haven't tried already, is place tiny trades. Like if you can get away with it, $5 trades, whatever it is, like tiny, tiny, tiny trades, whatever you can afford to place to protect your capital and keep your capital. Don't lose money. Don't lose your capital. That is rule number one. Don't lose money. So then put these filters in and live trade them. Set up a bot or something to just do it for you so you don't have to think about it. You can gather that data, have it stored in a database for you, and then analyze and assess that. Now, I shouldn't give any advice. I mustn't give advice. That's terrible of me to go and do this on this video because I open myself up to all sorts of risks there. But I'm giving you my own personal experience here of the best way to approach this stuff. Gather the data. Start with the backtests. You've all seen the backtests. They're all over Crypto Wizards. Like the backtest's already there for you. The backtesting video's already been done for you. It's all there. The forward testing now. This is giving you insights into what filters you might want to set for your live testing. Go and live test. Go and live test and use money that you're prepared to lose. So you might lose all your money because number one, likely you might also program something wrong. I've done it. I've lost literally hundreds and hundreds of dollars by messing up my code when doing live testing with real capital. But go and do live test. You might lose all your money. It's fine. It's not fine. Don't lose your money. But get the data. Get the data. Experience the market. Get the experience. And that will let you know, okay, what is really giving alpha. Also, let the data run. When you do this, don't just do a few trades and then they're showing a loss. And then you're like, oh, it doesn't work. You know, going back to our Ornstein-Uhlenbeck, where was it? I think it was up here. Yeah, this one over here. So over here, the Ornstein-Uhlenbeck spread over here. If you had done that, you would have said, this is useless. It loses money. But if you're just being patient and stuck with it, you'd see over time it actually did really well, potentially, depending on how the execution goes and what you're trading. So those are my key takeaways over here. Also, we don't have enough data to say for sure what features are the most useful. Also, there's something known as concept drift. So what worked today might not work tomorrow. This is the game. This is trading. There's no set rule. There's no set system somebody's going to give you that's just going to work. You have to experience the market. You have to move with it. You have to look at the data. You have to always put statistics in your favor. And if you do that, you stand a much better chance of being successful. I'm not a trading guru. I don't trade for a living. I have no right to tell you what to do. But this is just from my own experience here, what I feel is important to say. Finally, what I'll also say is statistical arbitrage, both with like co-integration, but also copulas and all of that. There is an edge there. There is a clear statistical edge, but that's only half the battle. Execution is the other half of the battle. If you're not getting execution right, you're going to lose. I mean, you cannot make money without execution. So it's the most important part, actually. But that said, you do need the best signal. And it's very clear to me that there is alpha in statistical arbitrage, especially in crypto. You know, when we look at the backtest, so if I go to Crypto Wizards over here, actually, and let's just go and switch this over to foreign exchange. When I look at the Sharpe ratios in Forex, they're way, way lower. Look at this. And the returns, they're way lower than when I go and switch to, say, Binance or some kind of cryptocurrency. And that comes with risks. It comes, obviously, higher reward, higher risk. But here, when you're looking at things like Forex and stocks and whatever, in fact, let's go and look at stocks and other. Okay, stocks much better than Forex, actually, from what I can see here. The thing that I think a lot of people do with Forex is they decide to, hey, let's go and just whack up leverage. So they find, a Forex broker who really exists just to take your money. And they think, okay, I'm going to do this with extreme leverage. And maybe you're successful. If you're successful at it, that's great. But what I'm telling you here, it's very clear to me that in crypto, it's an inefficient market right now. I know that a lot of people are interested now and getting interested. I say people, institutions are getting interested in statistical arbitrage in crypto. I've heard that from many different sources. And so there's clearly here an inefficient market in crypto. Anyhow, this was just a quick update. I hope you got some insights from it. Until the next one, take care and talk soon.